Well, we're going to really start off with the broad market because we're at an inflection point. And so I just want to give everybody the context that I'm seeing and what the expectations are on our end and the levels that really matter. But just to kind of get started, just to kind of break it down, you look at this right here and it looks like a jumbled mess, and it's really not. It's moved in an orderly, symmetrical fashion, which is what you want to see in corrections. They typically move in three waves, and they all are symmetrical. The problem is when you get to the end of the correction, the question you have is, was that it, or is that just the first leg in a much larger correction? And to give you an idea, at the very top right here, you follow me here, we have 1, 2, 3 down, 1, 2, 3 up, 1, 2, 3, 4, 5, right? And so this move into let's see, right here. So 3, 3, and 5, right into late February. At this moment around in here, the question is, well, is that all we got? Was this just a correction in a bigger bull market? And what ended up happening, obviously, is instead of getting 5 waves up, we just got 3 waves up and then failure. And then, so basically what ended up happening was this move right here was just the first leg in a larger correction that ended on June 16th, right? And now we're at the same inflection point. Well, was this bigger move that we just went through, was that it? Or is that just the first leg in a much larger bear market that would probably last into 2023 if that were to manifest? And so we're going to go over that. We're going to go over the levels that matter. This kind of analysis, you work on probabilities. And what I mean by that is these patterns we see play out time and time and time and time again on all time frames, on decade-long charts, on 5-minute charts, and they all have an order that they tend to follow. And so one thing that I want to point out, if this is the larger A wave and we're in this larger B wave, you might ask me, well, why isn't this the B wave and we're starting the C wave down probably into the end of the year? And the reason I say that, once again, getting back to probabilities, is because if we were to measure the length of this assumed A wave, the B wave tends to be at least a sixth to almost sometimes even longer than the length of the A wave, which would be right around in here in November. I rarely see a B wave of this magnitude only be in length of time a third of the length of this A wave right here. It's extraordinarily rare. Can it happen? Of course it can. We've seen a lot of improbable scenarios happen in this bear market. So I would leave that on the table, but it's one of those situations that's even more rare than others that we have seen in this prior year, which is why if it were to play out, I would expect this to be an A wave, this a B wave, and we get one more C wave push probably up until September. And those time factors I identified, October, maybe even push into November, if we really get some kind of catalyst behind us. So that's one reason why, we're not selling everything or thinking we're going immediately down. But that is on the table. I'm going to go over what that would look like. I still find it to be, it's more probable today than it was, say, last week, but I still don't have it as like the most probable situation right now. But that's the first reason why I wouldn't put this as that's the end of the bear market rally, the bigger one, and we're going down to like 3,200 immediately. It's definitely something to factor in. So moving forward, well, what could be playing out? And so I have 3 scenarios. And I mentioned once we got this 3-wave move, I kind of warned everybody, it's going to get messy. It's going to get confusing. Expect big swings. It's going to be difficult to map. You really can't map and target things accurately until you get 5-wave moves. These 3-wave moves open the door to so many scenarios, which we are now continuing to be in. This is the bullish scenario right here. Call up my blue count. And this is what it would look like. So it would be in the form of what we call a diagonal, which is a 5-wave move that's very overlapping. And this is very overlapping. The probability of this being, a high probability started to decrease below that 4,000 level. We really went down to the extreme support. You see this trend line right here? It held that, and this reversal today was important. We want to see a big follow through tomorrow or into Tuesday. And if we get that, that would be a really good move. But what we need to justify this is we got to get above 4330 and the S&P 500, which, I know it feels impossible right now, but it also felt impossible to be down here back in mid-August. We were raising quite a lot of cash in this region right here. And we actually got some angry emails into our customer support on why we were doing this. A lot of people thought the bear market was over. We were hoping it was, but we still were warning this is just 3 waves, and if we get a reversal, we expect it to be, I wouldn't say we weren't expecting to go down this much, but here we are. And so we have to factor that in. We have to pivot with what the market's giving us. The other scenario is what we talked about earlier, which would be the red scenario, which is this right here. That this is the A wave, this is the B wave, and we get a C wave push up into the 43.5, 4,500, maybe even up into this 4,700 range. Once again, it seems very improbable that would happen. And also you might be asking, what would separate this move right here from distinguishing it from the blue one, which would also be going up into the 43 range? And it's real simple. C waves are always 5-wave patterns. So it would be a very distinguished 5-wave pattern. It would be quite powerful. It would draw a lot of people in. The blue wave would be a diagonal, so it'd be a 3-wave pattern. So it would be quite distinguishable on what's playing out based off the structure off the low, okay? The other scenario that I want to point out is what I'm now calling my orange count. And it would be this right here. And that would be basically that we see a 3-wave move down probably into the 34.8 is the next confluence zone below double bottom. And then 32.90 would be below that. And so it would probably be taking the shape of some kind of a diagonal. There's many ways this could be counted. This could be counted as an expanded diagonal, a really extreme one. We have an A, B, and a C right here. Or it could be a diagonal, a really improbable diagonal in a much, much larger bear market that's playing out. I don't want to go there until we actually get confirmation of that happening. And if we do, we'll start game planning for that. But worst case scenario, I still find it to be the most improbable right now, is that this is a very large degree first wave. And if that is the case, we would get a very large degree second wave back up into these regions right here over probably a 6 to 9 month period before the large degree third wave would take us down. And we would have very good warnings of that. So if that is the worst case scenario where this is like the major top, you would have a lot of time to prepare for that top, put on a net short position, hedge, whatever you want to do before that third wave goes down. I still find that this has been too controlled of a bear market for me to go into that right now. And there's a lot of reasons why I still find it to be improbable, but you got to keep that in mind. If we do go down lower, if we do break down immediately, probably into September, October, into the 3,400 range, we have to start game planning for this. Whether it's going to be an A, B, C, and then we get our bull market after that, or we're starting something much nastier. But this move right here would be in a 3-wave move because we're in this diagonal, right? And so keep in mind, this move off the low is a 3-wave move. So this would be your A. I would expect B probably to take us up to the 41.3, maybe the 4,200 range. Before we get fully hedged and go back down. But once again, this would unfold in a 3-wave move. Okay. So a lot of scenarios to unpack here. The levels that matter the most, I would say, this reversal today was big. I want to see us go above, what is that? 39.70 to confirm that this bigger bounce is unfolding right here. Whether it's going to be the blue, the red, or the orange was yet to be determined. But I do expect all 3 of those scenarios to take us up into this 41.30 to 4,200 range before the market makes a decision. So that will give people time to raise cash, do whatever it is you want to do. We likely would be adding our hedge back on in a pretty meaningful way up in this region with the stop probably above this 43.20 range. So, okay. So quite a lot to unpack there. I hope that made sense. We'll know more in the coming weeks. Like I said, the coming weeks are going to be very important, and they're turning out to be that. But the market has not made a full decision yet, so we should know by next week and the week after. So supporting markets, to me, the oil market is extremely important. This, if you pay attention to inflation data, which is really driving fear and driving Fed decisions, it's predominantly oil driven. Just the squeeze in oil is just causing oil and housing, but I mean predominantly oil and gas and energy prices. And so we had this breakout and false breakdown. There's a false breakout and a breakdown, and we've just gone down since. And I find that to be great. The lower we can go and the more we can stay range bound for the longest period of time, the better the CPI numbers are gonna look. The better the PCE numbers will look for the Fed's decision making. They want to see a trend of slowing inflation, and I think oil and energy is going to have a big part of that. And so I hope we stay range bound for months. I would love to see that, but we definitely are going to see elevated inflation. Lower inflation going into August as well. So that will be a boon for the market. That's something to factor in. But once we break out above 30.94, and I expect it to be a dramatic breakout, a gap up, expect that fifth wave to happen. And that's going to put pressure on markets. This is what we're tracking right now. This is just too corrective of a pattern, 1, 2, 3, to suggest a larger trend is down. It could be, but it could be taking the shape of some kind of A-B pattern, but as of right now, we're following what's the most probable. And so I just wanted to point that out. Now, the other supporting market that's holding down equities is rates. And we put the lines in the sand. We had a gap down today and couldn't quite make it back up. And I think that we are going to see a new high in rates. I think it's going to be on lower volume, and I think it's going to be a phenomenal buying opportunity for long-term bonds, if you ask me. And I'm looking at that 106, 105 range. There's a lot of confluence there where we should see some support. But, rates are closer to a low than the market. That's important to factor in. But, the bond market was giving us a warning as equities were going up in August and bonds were going down. And that's always an important divergence to pay attention to. The bond market is typically more in tune. All the bond market cares about is growth and inflation. That is it. And that is really the only thing that matters with equities right now. So just keep that in mind. The one good piece of news is the dollar. So the US dollar has been putting pressure on equities. We're getting more signs of this 109 level being pretty important. We got one more high on much lower momentum. And so we're seeing some accumulation distribution right here. And the dollar got stopped at that 109 level on lower momentum. So we'll find out soon. This is going to explode higher, explode lower because of this accumulation that's going on right here. But all signs point to the dollar is marching closer and closer to a meaningful top. You're just seeing it with central banks as well. I mean, the ECB has to get much tighter. I mean, what was it? Germany just posted like the consumer prices were the highest they've seen since 1973. They continue to accelerate higher, toward the U.S. has continued to accelerate lower. And so the ECB is being forced to get aggressive on inflation while in the midst of a horrible energy crisis, while the Fed is likely getting closer to stopping. Whether or not they're going to say it or not, we're probably getting closer and closer to stopping the rate hikes as the ECB is at the kind of the beginning stages. So anyway, long story short, the dollar will turn, and probably will turn sooner than later, in my opinion. All right, so those are the supporting markets. That's kind of the bigger picture.